This video will understand the recent RBI's guidelines on the revised risk weight based capital adequacy norms. RBI's draft circular signals a regulatory shift that could enhance capital efficiency for banks and credit card issuers with a higher transactor base. So, how this is possible? Let's understand further. So let's understand what's the current capital adequacy requirement. So let's assume that we have a credit card outstanding of 100. There is an uniform risk weightage of 125% which is applied, which means the credit card outstanding becomes post the risk weightage at 125 rupees. A CRAR rate has been applied of 15% as per the regulatory guideline. The CRAR is nothing but the capital to risk weighted assets ratio. If you apply the 15% on 125, you arrive at 18.75, which will be the capital requirement. So this is how the current system works. We go to understand what's the revised guidelines. We must also understand what's the types of credit card users. We have two types. One is the transactor. The transactor credit card user is someone who pays their full balance by the due date every month, avoiding interest and late fee penalty. On the other hand, a revolver is one who pays only the minimum amount due and carries forward the outstanding balances and incur interest charges. So while a revolver is good for the revenue of the credit card company, a transactor is one which provides a very stable um, cash flow pipeline. How does the revised capital adequacy requirement work? So, as per this, the credit card outstanding is split based on the dues of the transactor users and the revolver users. Typically, for example, in State Bank credit card, they have a 40% transactor base and a 60% revolver base. So, assuming that dues are also split in that ratio, for transactors, the uniform risk weightage is reduced from 125 to 75, whereas for the revolvers, it still remains as 125. So post applying the risk weightage, the transactor balance comes to 30, the revolvers is 75. After applying the CRAR rate of 15% uniformly, the capital requirement is 4.5 and 11.25. The total comes to 15.75. So it's very clear that the earlier 18.75 capital adequacy reduces to 15.75, a reduction of 16%. Now, obviously, this percentage will increase as and when the banks have more transactor volumes. This has come as a shot in the arm for credit card companies like RBL or SBI cards and so on. So obviously, the first thing is that it's expected to free up the capital because of the reduced requirements. And secondly, the card issuers will now focus more on high quality transactor type because they're incentivized to have such users to reduce their capital adequacy. For being with us. In the next session, we're going to understand the more complicated ECL provisioning guidelines released by the RBI's recent circulars. So we'll have a look at that. Thank you.